What's up guys, my name is Nick and welcome to my channel. In this video, I'm breaking down my first quarter trading results for the 10K challenge that I'm currently running on the channel. If you're new here, I'm basically trying to build a small $10,000 account with a goal to maximize absolute returns. We'll be looking to build the account to an initial target of 25K and then beyond that. In this series then, I'll not only be sharing the account performance, but also insights into how I got there. We'll take a look at some of the trading strategies I use, as well as the risk management, hedging, and position sizing techniques I employ to try to rapidly build the account equity. Before we get into the video though, do me a huge favor, gently tap the like button, subscribe to the channel, and turn on the notification bell. It's free of course, but it helps push my content out there and ultimately grow the channel. Thank you, it's very, very much appreciated. With that said, let's get into the video and see how we fared in the first 3 months of 2021. I'll see you guys on the other side. Okay, so as of the 31st of March, the account net liquidation value was $18,667. Given the additions that have been made to the account, specifically $3,000, the net return of the additional account equity is 59.25%. If you're wondering about these additions, I explained the rationale for making regular contributions, regardless of their size, in order to help build any small account in the first installment in this challenge. And if you haven't seen that video, I suggest you watch that now. I'll include a link somewhere up here. So, the first thing to address is the slowdown in the rate of profit growth. Following January and February, the average monthly gain was in excess of 25% per month. These levels of return are clearly not sustainable in the long run, and as I mentioned in the first video, a return to more normal levels and some sort of consolidation was extremely likely going forward. For the month of March then, the overall return was just shy of 7%. This is significantly less than either January or February, but by any reasonable standard is extremely high when you consider this is just a couple of percentage points short of the average long-term annual return on the S&P 500. What we've seen recently then is a number of trends in certain sectors like financials, the automotive industry, and energy, for example, entering a period of consolidation and taking a breather. In the earlier part of the year, moves in stocks in these sectors helped push profits sharply higher, and during March I started to take some of those chips off the table as the rally started to run out of steam. Because of the nature of my trend following exits, I use trailing stops rather than profit targets. It does mean I will never sell the very top, but rather the aim is to protect those profits already made by gradually raising my stops higher as the stock rallies. This gives a trend the room to move and an opportunity to move higher, while at the same time ensuring that we don't give too much money back to the market. The ultimate goal is to allow our profits to run, and a stop loss of this nature allows that. It does mean though, as trends start to falter, we do enter a drawdown as we give back some proportion of the money that we've already made. As such, the account is currently in a 5.2% drawdown. That is, the account reached an equity high of $19,683.93 on the 15th of March and has since given back just over $1,000 in profit. In the context of the volatility of the returns in this portfolio, this is well within the expected variance of the account net liquidation value, and I don't expect this to be the maximum drawdown we occur over the course of a year's trading. Higher returns come at the expense of higher volatility. It's extremely unlikely, for example, that we might see very steady, very similar returns month in, month out. If that is your objective, let's say you're trading a multi-million-dollar account, for example, and you need to generate consistent monthly retirement income, then that's totally achievable. But this is a very different trading objective than absolute returns, and so requires different strategies, position sizing, and risk management. The hedging strategy in this account has also contributed to a significant proportion of the losses due to losing trades that occurred in the account this month. The account runs a long VIX call option strategy. It's important to understand when the market has a relatively minor pullback, this hedge will be totally ineffective. A sharp spike in the VIX is required before this strategy will bear any fruit. To be clear though, the intention here is not to make money. It's a worst case insurance policy designed to cover a significant tail risk or crash event such as that seen in March 2020, and I fully expect the trade to generally lose money over time. What I've tried to do is balance the size of this hedge, allocating no more than the maximum of 4% of the account value per annum or 10% of the net profit. This means that as the returns of the portfolio grow at a very high rate of return, so additional funds are made available to increase the size of the hedge and ensure that we're not vulnerable to a significant drawdown in the event the broader market significantly corrects. But right now at least, this is basically a drag on the overall returns, but it does mean it's easier to sleep at night. The VIX, of course, also continues to be pressured on its one-year lows. Again, as I discussed last month, this low volatility environment has meant almost all of the trades have been long premium trades, and in fact there was just one short premium trade in March, a short put credit spread on US steel that was able to close for a nice profit very quickly due to the combined effects of a sharp move higher in price and a fall in implied volatility. In terms of the long premium trades, I use a strategy that looks to buy a call into a move up in a stop price and look for this short to medium term momentum to continue until I'm able to then leg into a higher strike call and create a low risk or potentially risk-free debit spread. I think this strategy is interesting enough to produce a whole separate video looking at that technique, and I hope to be able to put that together in the not too distant future. Let me know in the comments section below if you'd be interested to see that. Finally, I have expanded the universe of stocks in my watch list to reflect the higher value of the account. My watch list now includes all liquid counters up to $60 in price, and I expect to include more tickers at higher prices going forward, provided of course we continue to see the account grow. This update is something I do at least once a quarter and more often once a month. This keeps the most liquid, appropriately priced stocks on my radar and means more trading opportunities are likely to become available. Guys, if you made it this far, you made it to the end, and your support is very, very much appreciated. If you have any questions or feedback, please feel free to drop them in the comments section below. I answer them all personally. Additionally, I run an active Facebook group where I'm interacting with traders just like you on a daily basis. It's an opportunity to ask me any questions you might have in regard to options and options trading, but in real time. There's a link in the description below, and I encourage you to join the forum. It's free, of course, but there's a ton of valuable posts and comments every day from both myself and other experienced members in the group. Before you disappear, don't forget to subscribe and turn on notifications. I produce new content weekly. I've also included a link to other option-related content on this channel somewhere over there. Again, many thanks for your support. I'll catch you on the next one. Stay safe, guys. Cheers.